In less than 48 hours, gold went from unstoppable to down double digits intraday, and futures were suddenly trading about 18% below a record high, near $5,626 an ounce, 8% on the day after being nearly 10% lower earlier in the same session. Silver didn't just wobble, it slid with it, and the official explanation sounded almost too clean. Volatility happened, traders got nervous, and prices fell. But that story skips the part that matters. Because what took metals down wasn't simply fear, it was plumbing, it was collateral. It was the invisible machinery that decides who is allowed to stay in the game when a market stops behaving nicely. And when that machinery shifts, it doesn't ask whether the long-term thesis is right. It asks one question only: can you post the cash today? They said this kind of move could never happen in an asset that protects against chaos. Not months, not weeks, in 48 hours. That's your first clue that you're not watching a normal repricing. You're watching a forced repricing. And here's where it gets interesting. Institutions already knew the pressure point before most people even realized it existed. The moment margins rise into a falling market, the outcome is not a debate. It's a sequence. Sellers appear who don't want to sell. Offers hit the book that have nothing to do with conviction. And the chart prints a story that looks like a collapse when it's really a leverage reset. What I'm about to lay out isn't opinion, it's pattern. It's how exchange rules, clearing risk models, and crowded positioning interact. If you understand that interaction, the metal's takedown stops looking mysterious and starts looking inevitable. Welcome to Channel Name, where we decode what matters before it becomes a headline. If you've ever felt like markets move in ways that don't match the narrative, you're in the right place. Consider subscribing the way you'd listen to a wise elder, not for hype, but for signal. And tell me in the comments where you're watching from, because this story is global, and it's unfolding differently depending on where you sit. Now, let's reconstruct what actually happened. In late January and the first days of February 2026, the metals complex was already stretched. Prices had run hard, momentum had pulled in late buyers, and leverage had accumulated quietly in the background. Then the market hit a wall. A sudden repricing in interest rate expectations, and the dollar, fueled by a headline that cut straight into macro positioning. Donald Trump announced Kevin Warsh as his pick for Fed chair, and whatever your view of that choice, markets immediately translated it into a different trajectory for policy and the currency. The dollar strengthened, rate expectations shifted, and anything that had been positioned as an alternative to cash had to prove it could hold up under a new path. That's the macro layer. But the micro layer is where the damage happened. As volatility exploded, the CME raised margin requirements, 6%, 1%. Those numbers look like administrative details until you translate them into what they mean for a leveraged participant. A margin increase is not a suggestion, it is an invoice. If you're long futures, you don't own a bar. You own a promise to settle a contract. And the exchange, via clearing, demands performance bonds to ensure that promise is good. When the exchange raises the bond, your cost of carrying the position rises immediately. Combine that with mark-to-market losses from falling prices, and you get a double hit. You lose equity, and you owe more collateral at the same time. That's a margin vice. And it's how liquidations are manufactured. So, the central mystery is this. Did metals fail, or did the structure force them to be taken down? To relieve the pressure building in the system? The answer starts with history, because none of this is new. In 1980, silver didn't simply fall because sentiment changed. The Hunt brothers episode is remembered as a mania, but the end game was mechanical. Exchange rule changes, margin hikes, and trading restrictions accelerated forced liquidation. When the cost of holding a position is raised while prices are already under stress, the weakest hands are not the ones with the least conviction. They're the ones with the least liquidity. In 2011, silver again surged and then snapped. The same playbook appeared. Repeated margin hikes in quick succession, volatility spikes, and a cascade that felt like a trapdoor. The chart looked like the market decided silver was too expensive. But the plumbing shows something else. The market decided leverage was too fragile. In 2013, gold suffered a brutal break that shocked people who believed central bank policy made declines impossible. Again, liquidation pressure in paper markets ran ahead of physical adjustment. And in March 2020, during the scramble for dollars, even perceived safe assets saw violent moves as funding markets seized and collateral was king. The common thread isn't ideology about metals. It's the same sequence. When liquidity becomes the scarce commodity, even assets bought as protection can be sold to raise cash, meet calls, or de-risk portfolios. Now bring that pattern into 2026. This time, there was an additional accelerant that most viewers missed. On January 13th, 2026, precious metals contracts shifted from fixed dollar performance bonds to percentage of notional margins. That sounds technical, but it matters because it changes how margin behaves when price rises. Under a fixed dollar scheme, margin can lag behind price. Under percentage of notional, margin grows automatically as the contract's dollar value rises. In other words, as metals rally, the collateral burden scales up in real time. That's fine in a calm market. In a manic market, it quietly loads the spring. So when gold surged toward a record, the system was already demanding more collateral from anyone holding futures exposure. Then volatility hit, and the exchange increased percentages again. The spring released. Now, who moved first? The exchange set margin. Clearing members enforced it. Prime brokers and futures commission merchants demanded cash from clients. Risk departments tightened limits. And large, sophisticated participants with diversified funding sources repositioned faster than everyone else because they understood the calendar. They knew when margin schedules could change. They knew how risk models respond. They knew what happens when volatility and collateral requirements rise together. Meanwhile, the broader public saw only the price. Start with the exchange itself. CME isn't a trading desk, but its rulebook sets the gravitational field for everyone who is. Every futures contract sits inside a chain. Trader to broker, broker to clearing member to clearinghouse. When volatility rises, the clearinghouse asks clearing members for more protection. Clearing members push that demand down the chain, and brokers push it to the end client. It feels like a sudden eviction notice. Now add the bullion banks and large dealers. They sit in the middle of two worlds. They make markets in paper instruments, and they source and place physical metal. Their business is not to be permanently long or short. It's to manage flows, spreads, and balance sheet usage. When financing conditions change, they adjust. If collateral becomes more expensive, they pull back from warehousing risk. That can widen spreads and make the market feel thin precisely when everyone wants to transact. Then there are ETFs and structured products. Even without naming tickers, the mechanism is straightforward. When price falls sharply, some vehicles see outflows. Those outflows can force selling of metal or futures exposure, depending on structure. At the same time, option dealers hedge gamma. In a falling market, hedging flows can become one way. As prices drop, dealers may sell more futures to stay hedged, which adds to pressure. It's not a conspiracy. It's a rule-based response to the way options are priced and risk is managed. Macro funds treat metals as part of a rates and dollar trade. When inputs flip, risk limits force exposure down fast. Now zoom out to the official sector. Central banks don't trade for quarterly performance. They trade to diversify reserves and to reduce dependence on any single currency system. That's why it matters that 2025 still saw 863 tons of net central bank demand, with 230 tons in Q4 alone. That's a steady, methodical bid that tends to show up on dips, not on breakouts. It's also why short-term price collapses can be misleading. A market can be slammed by leveraged selling even while the foundational buyer remains present. The honest answer is, nobody has to coordinate when the incentives line up. Exchange risk rules, broker collateral calls, option hedging, and portfolio VAR all push in the same direction at the same time. Coordination is optional, structure is sufficient. Now look at timing. The shift to percent of notional margins on January 13th quietly increased the carrying burden as prices rose. Then, as the market moved violently, the jump to 8% for gold and 15% for silver magnified the squeeze. Those are not tiny tweaks. They are large enough to force a decision. In calm conditions, a trader might roll positions, rebalance, or wait. In stressed conditions, the margin call sets the clock. Miss the clock and positions are reduced for you. This is why the price action looked like it was designed to break confidence. Forced selling has a particular signature. It doesn't care about levels. It doesn't pause at a trend line because it's not a human decision. It's a liquidation algorithm and a risk department checklist. The market prints through supports because the seller isn't optimizing. The seller is surviving. That's also why rebounds, when they happen, can be violent. Once the forced sellers are gone, the auction changes character. Suddenly bids can stand in. Suddenly the market can move on fundamentals again, or at least on discretionary risk-taking. But it's often just the market returning to two-sided trade after an eviction wave. Here's another contradiction that reveals the plumbing. When paper prices fall, you would expect the world to be flooded with selling of physical metal too. Yet the physical ecosystem often responds with hesitation. Refiners, fabricators, and jewelers don't instantly scale operations because a screen price dropped in hours. They wait to see if the price is real. Meanwhile, holders of physical metal don't face margin calls. They may be less motivated to sell into a downdraft. That difference in constraint matters more than sentiment. The East versus West angle matters here as well. Western paper markets dominate price discovery because they are liquid and leveraged. Eastern demand often expresses through physical buying, especially when prices dip. That creates a rhythm. Paper sells first, physical responds later. When that rhythm is strong, price can whip down, then stabilize as physical absorbs supply. When it's weak, paper selling can continue without a cushion. It's a market split between those forced to act and those free to wait. And once you see that split, The move stops looking like an argument about whether gold is valuable. It becomes a test of funding conditions. If funding remains tight, leveraged positions keep shrinking. If funding eases, the market can rebuild. That's why the headline about a Fed chair pick mattered. Markets price future policy through the dollar and real yields. A change in expectations can tighten financial conditions at the margin. And in a market that was already carrying more collateral because of the percent of notional regime, the tightening can be the last shove. This is the part no one is discussing. The takedown isn't a moral judgment about metals. It's an institutional response to disorder. Exchanges exist to reduce counterparty risk. Their job is not to maintain prices. Their job is to ensure settlement. When volatility rises, they raise collateral to protect the clearinghouse. That's rational, but it has a side effect. It forces deleveraging, and deleveraging pushes prices down, which raises volatility, which justifies more collateral. That feedback loop is how air pockets form, and that's why the metal's drop felt so sudden. It wasn't just selling. It was selling plus collateral calls, plus forced reduction of risk across portfolios that were correlated in ways people didn't want to admit. Now let's talk about the dislocation, because this is where the story gets bigger than one chart. Paper metals trade at the speed of algorithms. Physical metals move at the speed of logistics, refining, vaulting, and settlement. When the paper price collapses, the physical world does not instantly produce extra supply. It reacts with delays. That creates windows where the price and the availability don't line up neatly. In the London Vault system, in December 2025, holdings were reported at 9,106 tons of gold and 27,818 tons of silver. That's an enormous stockpile. But stockpile is not the same as float. Much of it is allocated, pledged, or held for specific purposes. When paper prices whip around, the question becomes, how much of that metal is truly available at the screen price? At the same time, central banks were still accumulating. The World Gold Council reported net central bank demand of 230 tons in the fourth quarter of 2025 and 863 tons for the full year 2025. Those are not small numbers. They represent the slow official bid that doesn't chase candles and doesn't puke positions on margin calls. Central banks can buy through weakness. Leveraged futures traders often cannot. So you have two forces. One is fast, leveraged, and collateral sensitive. The other is slow, strategic, and balance sheet driven. When the fast force is forced to sell, the price prints down. When the slow force keeps accumulating, the underlying demand story doesn't vanish. It just gets masked by the liquidation. That's the dislocation. The paper market screams collapse, while the physical and official backdrop tells a steadier story. And because it's a dislocation, it cannot persist indefinitely. Either physical demand retreats and validates the lower paper price, or physical demand absorbs the liquidation and forces paper to reconcile with reality. The market is essentially running a test. Was the rally a leverage bubble, or was it a repricing supported by durable demand? To understand how that test plays out, you need to see the mechanism in simple terms. Think of futures leverage like driving a car down a steep hill with a trailer attached. In calm weather, you can manage it. But if the road suddenly turns icy, you can't just believe harder in your ability to stop. You need traction. Margin is traction. When the exchange says you need more traction, it's demanding more weight on the wheels. If you don't have it, you unhook the trailer. That unhooking is liquidation. Now imagine thousands of participants unhooking at once, not because they all changed their mind, but because the road turned icy and the rules changed. The hill gets crowded. Everyone wants to exit the same way. Prices gap. That's what margin hikes do during a volatility spike. They turn normal repositioning into a stampede. And it wasn't only margin. It was also the behavior of risk models. Many institutions run value at risk frameworks that scale exposure down when volatility rises. If realized volatility jumps, risk budgets shrink. That means positions across multiple assets are reduced simultaneously. If gold and silver were held as part of inflation hedges, risk parity, or broader macro baskets, they could be cut not because the metal story changed, but because the portfolio's risk math changed. This is why correlations spike during stress. It's not psychology, it's mandates. So when you look at the sequence, macro repricing, margin hikes, volatility spike, VAR cuts, you get a coherent explanation for why a safe asset can fall quickly. Safety doesn't mean immune. It means valued over time. In the short run, funding rules dominate. Now, let's get concrete with the numbers, because the numbers are the evidence. Gold futures were reported near 4,922 after being roughly 18% below the record peak, near 5,626, 8% on the day. Silver was pressured alongside, with higher margin rates applied to a market that is, historically, more volatile and more prone to squeezing and crashing. 5% under heightened risk. Those are not abstract. If a participant is holding exposure with tight cash management, A jump from 6% to 8% is a 33% increase in required performance bond. For silver, from 11% to 15% is a 36% increase, and that's before you account for losses from price declines. If you're down on the position, your equity is already eroded. Now you need more equity. That is how forced sellers are created. It has a technical answer. They had to be taken down because leverage had to be taken down. The market needed to find a price where the remaining holders were those with cash, not just conviction. Now consider what changed structurally in January. Moving margins to a percent of notional. As price rises, collateral rises. That makes high prices more expensive to hold. It doesn't prevent a rally, but it makes a rally more dependent on fresh liquidity. When liquidity turns, the reversal is sharper. So what does it mean going forward? Historically, when a margin-driven liquidation breaks a parabolic move, one of three outcomes tends to follow. In the conservative scenario, volatility subsides, margins stabilize, and prices chop sideways as the market rebuilds positioning. The liquidation flushes out late leverage, and the market spends time digesting the move. In this scenario, the key indicators are whether realized volatility falls and whether open interest stabilizes rather than collapsing further. When forced selling ends, price stops gapping and starts trading like an auction again. In the moderate scenario, the liquidation overshoots, physical demand steps in more aggressively, and the paper market is forced to reprice upward to restore balance. This is where premiums, delivery tightness, and the behavior of physical flows become important. If the screen price drops, but physical doesn't get easier to source at that price, the discrepancy becomes a signal. In past cycles, that tension can lead to sharp rebounds once the forced sellers are gone. In the aggressive scenario, stress migrates from metals into broader funding markets, and the sell-off becomes part of a wider deleveraging event. In that case, even assets with strong long-term demand can fall as everything becomes a source of cash. To tell, there's not a metals chart. It's funding spreads, collateral scarcity, and whether other risk assets begin to behave similarly. Notice what's missing from all three scenarios: certainty. Markets don't give certainty, but history gives probability bands, and the probabilities are shaped by plumbing more than narrative. So what should be watched? First, watch margin policy and volatility. Not opinions, not takes. Look for stabilization in collateral requirements and realized volatility. Second, watch participation, whether open interest collapses or stabilizes. Third, watch the paper versus physical relationship. Not in vague terms, but in observable signs like persistent premiums, delivery frictions, and unusual regional price gaps. Fourth, watch official sector behavior, because central bank demand has been a steady baseline in recent years. If that baseline remains, it changes the character of sell-offs, because it means the market is not facing a vacuum of demand. And this brings us to the real divide. There are two kinds of market participants in events like this. The first group sees only the price and the story attached to it. They believe a drop is proof that the asset is flawed. The second group sees the mechanism and the context. They recognize when a market is being relevered or delevered, and they understand that a forced move says more about funding constraints than it does about value. This isn't about being smarter. It's about paying attention to the parts of the market that aren't on the chart, because the information gap becomes the wealth gap. Institutions move first because they monitor the system, not just the screen. Retail tends to move last because the screen is the system they're shown. When you understand that, the metal's takedown stops being a shock. It becomes a case study, a high-profile reminder that in modern markets, collateral is the real currency during stress, and price is often just the symptom. This is channel name, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen before, you know what to do. Because the question isn't whether markets will keep using this playbook. The question is whether you'll recognize it early enough to understand what's actually happening. While everyone else is still arguing about the storyline,